And we are back, episode 216, a very special episode. We've got Scott from Terem Capital in the house. We'll do our fantastically loved, much loved deep dive. So obviously, Scott from Terem, what do you do with yourself? Tell us, our audience who haven't listened to one of our amazing episodes.
Hey everyone. It's good to be back.
You're obscured. You know, on my angle, you're obscured now because of these great microphones.
Oh, so if I go down a little bit, we won't meet
the
eyes.
Microphone holder is slightly obscure. So if you thought that the main reason I came to these things with you was because of your appearance, that would be diminished now because of these two bars.
Well, the thing I wanted to understand, there's some seating here that, you know, your kind of toes butt up against. And I was wondering, did you guys subject the Shadow Treasurer to
He did.
To
he was in literally the same
You didn't
seat
give him
we
the
were in.
good chair.
He didn't complain though.
He did not complain.
He had to tuck his feet in a little bit.
Maybe that's why Jim Chalmers won't come on the show, because he doesn't want to tuck his feet in.
Oh, that's the reason.
Promise him the good chair.
When you're a shadow treasurer and you're a politician, you've been through more personal pain than bumping your feet against the bottom of a table.
I've just got to step
But obviously,
up.
when you're investing in businesses, people are massaging your feet all day. So the minute you don't feel that, you're like, God, this is a horrible place to be.
How do I invest in these feet massage related businesses?
We can talk about that. We can talk about that afterwards. You should tell people what you do for a living.
Yep. So for a living, I buy small technology companies with between 1 and 10 million in revenue. Yep. And we look for business to business.
So just under the CGT threshold, perfectly positioned.
Yeah, I mean, I would love to say that I lobbied hard and got that number in, but when I read it, I thought, wow, that's pretty close to...
It wouldn't have mattered if you lobbied hard because they didn't listen to anyone that they were not already buddies with.
Yeah. I mean, I listen to Paul Keating and that's it.
So just on that 10 million number, I, of course, had to play around with it a bit and see what... And there is a real difference in... You know, if you're not growing super fast, there's a real difference in whether you exit just before the threshold and exit after.
And what kind of growth rates are you trying? Like, are you looking at, like, say, 3 years before you buy? What kind of growth rates are you looking for?
Yeah, we're typically looking for there's two tracks that we're looking at. One is the slower growth rate of like 5 to 10% year-on-year growth, and we look at it and say we'll get in and do a bit of work to get growth going a bit faster.
This is revenue or profit growth?
This is revenue. We look at revenue because it's hard to talk in technology world about profits. Everyone runs in some weird and wonderful ways with their P&L and also with how they view profitability. Because it's technology, people will be running
the CapEx
break
stuff.
even and using R&D, and
plus
so we just
know
talk
how
revenue.
To extract profitability out of businesses that haven't been traditionally profitable.
That's right. That's something I'm pretty proud of. Something we're able to do and keep them growing. I think is the other bit. I think it's a bit of a misnomer that profitability has to be sacrificed.
Will you do a Warren
Buffett
growth and keep the founders around, or will you sort of say thank you for all your hard work? We'll take it from here. What's the general?
Happy either way. I think that's one of the great things. People can walk away on day one. We're very comfortable putting someone in to run the business.
So you'll find
for us.
another CEO.
We'll find. And there's plenty of people, actually the listener base as well, that have reached out and are really keen on.
We have the smartest listeners in Australia, so I would suggest if someone reached out,
if you are interested, please say hello. And then
can I say this? Because I never pitch. Like, I love sales, but I never do sales on this podcast, like on the actual podcast. But I do want to say this. You just said these people reached out to you who are listeners.
Yeah.
I've had an investment bank tell me they picked up a couple of mandates because we talked about them on the podcast. I don't talk about them again because they don't pay us. A law firm, two law firms said the same thing to me. It is actually pretty remarkable that when we talk about things on this podcast, they do result.
Well, I don't think it's remarkable. I think it's
out.
Between you and me and Scott, if we've used someone for 5 or 10 years, if you use Goldman Sachs and I use Mills Oakley, or if I use Macquarie, like we can say from experience, we've had a great experience with these firms for 5 or 10 years. I've had a great experience working for Scott or whatever. And they can say, well, even if Adam and Adir are wrong, at least we can trust them that this is an honestly held view. So I think that's part of the attraction.
So I'm very happy that people are reaching out because I know there are a lot of, especially with these changes, there are a lot of people who are thinking about whether they crystallise their gains before the CGT changes.
Yeah, and I've had some people specifically reach out with that as a like, hey, this CGT change is coming up. We're really thinking about it. Can you help us think about what to do?
Are you agnostic about where in Australia they are?
Yeah, we're even looking at things in Singapore.
Wow.
That's great.
Yeah.
Good CGT regime there.
And one thing I thought I'd bring up, which came up in the last week in one of the conversations with a founder looking to sell was, and I'd love to know your opinions on it, which was, I'm looking to sell, my business is going well, and I think I can grow it even further over the next 3 years. Do I sell now or do I wait 3 years? I'd love to know
Sell
what you
all
guys
of it or
think.
sell part of it?
Sell the company. Well, we could.
Why would you sell now?
You
Why would
could
they sell
advise
now?
them to sell part of it. It's your.
Why would they sell now if they think they can have a massive 3 years?
That's what they're asking.
That's what they're asking. Because they probably didn't take big salaries. All of their personal wealth is tied up in the business. They're scared of losing that personal wealth potentially if the business doesn't.
But if you think you're going to do really well, like if you think you're going to do badly, for sure, sell.
Maybe they've still got a mortgage. They could still have a mortgage. I mean, you're not paying them $100 million. Like you're paying them.
No, not just to me, just to anyone. The
well,
advice is like, should I stick it out for 3 years?
Your
and get the
answer
growth?
is going to be the same as mine, I suspect. Where you're leading with this is try and do a secondary sale of a meaningful amount of non-controlling equity. So you can. So what I mean is, if you own 100%,
sell 20%,
sell 30 or something. Yeah, take that money off the table, put it in your pocket, and then actually that will dramatically increase your risk appetite to drive the next 70% of your equity hard. That's what I did. I do it with almost every founder I'm involved in. I try to organise a secondary sell down for them as early as I can.
If they're going, got their
if the business, because I always want them to take more risk.
Yeah.
And so I understand and appreciate that if all of your wealth is tied up in this one thing and you've never really taken a lot of money off the table, you've got a mortgage, etc. It's hard to take more risk and so yeah.
Scott, will you buy a 20 or 30% stake in a business or only 100%?
We're thinking about it, but it's not the primary.
Yeah.
It's not the primary. The challenge is that with that model, we need to make sure we're ultra aligned with the founder,
sure.
and that sustainable, profitable growth is a particular mindset that not everyone is aligned on. And funnily enough, the minority position situation mostly comes up in VC-backed companies, which the alignment is often hard to gauge because it's more important. We would love to, but it's more important that we're aligned on the mindset, the culture of that approach. And I'm not saying there's a right or wrong. It's just more that if we've got alignment on that, it can go well. Yeah.
I think the main problem that I have when I'm in minority businesses, the main upside I have is the founders that usually run these things are really good and really passionate, and I do not have to think at all about 95% of that business running. But the problem is, if I think something is like really good and really important, I can't just say do it because it's their business. Yeah. I have to like engage in like a sales pitch of persuasion. Yep. And as I become closer to them, like I get more effective. Like maybe the time frame of them doing it diminishes, but that is one challenge owning a minority.
How do you sell down a minority stake in let's say these 1 to 10 million businesses, which is where a lot of the economy is at? Not how like in your.
How
you
do
say
you
sell down a second.
Down, you mean?
No. I'm asking generally because this was
how
the
does
question.
Someone sell? Who do they sell
How does
to?
a founder sell down?
It's pretty hard.
If you're doing
It's pretty
5 million
hard.
revenue to follow your secondary advice, maybe you're growing well like 20% a year. You're profitable.
That's why I think there's a great opportunity for investors because it is such a small market. There is no. It's VCs really.
Well,
but VCs aren't going to buy that minority.
Well, no, it's not VCs.
They're not going to buy secondary. Yeah.
So it depends what the business. If someone has a motor mechanic and they've got 5 mil of revenue and they come to me and say, I want to sell down 20%.
I'm growing 20%. Like, let's say good economics.
I'm probably going to say, I don't know how to help you grow faster. I mean, maybe I could work it out, but like, I don't know. And so I probably am not the person for that. But if someone has a business, I don't know, like vertical retail, and they say, I've got 5 mil of revenue, but this is the situation. I look at it and I'm like, oh yeah, I see how this can be a rocket. Like I'm literally talking to one of them now. Like, then I might say, yeah, that's super enticing for me. But what I've learned through some not nice treatment in the past is I would need to have protections in place. And my preference would still be to own a majority, and if not, to have a mechanism for getting to a majority.
Would you call yourself a search firm? Is that broadly what? Because that tends to be sort of like a mini PE roll up.
Is that what they're called? A search
I wouldn't
firm?
put myself in a. I wouldn't put myself in a. I'm a founder like anyone else, and built a company and used my balance sheet to. I think that's different to. There's similarity, but a search fund is. usually I don't have any money. I'm a MBA or something.
Yep, exactly.
And I've thought I want to go and buy a business, and someone else is going to put up.
And often we roll up a bunch of
90
businesses.
to 100% of it. They might not even do a roll up. Often they're buying an older business, and they're going to just put their MBA to work.
Exactly.
No,
I love that concept, by the way.
I've never even heard of that word.
Really?
I'm
search
firm.
Yeah.
I know the
US
concept.
Yeah, it's
but
US
I don't
concept.
never heard of the word.
It's huge. It's huge. There's a Stanford session every year.
Yeah, my friend Ryan Eber's done that in Australia, one of the few, and he's done
But could I
really
say
good
that
job.
this is the philosophy? It is, I'm a smart person. I've done it. You've said an MBA. I've done an MBA.
Usually it's ex-MBA grads.
I'm going to say something a bit rough now, which is I can't really be bothered working my way up in a company, and I don't want to found something new. So just give me cash and bet that I'll figure out how to run it.
Well, it kind of makes sense in that you've got these really smart people, and you've got these, it could be an old air conditioning business, and there's a 70-year-old guy who's done a great job building his air conditioning business. He wants to retire, sells it for nothing. Then you buy 25 other, and you add technology. It's actually really smart.
Yeah, you don't have to do roll-ups in the search model, as I understand it.
You don't have to, but it's very common.
You could just get some growth going and implement some tech.
It's often old school businesses. It's not
you could buy, but I think what you're saying is very interesting because, there's a wave of people in the Western world that are 70 to 75 right now. And so they're probably just engaged in the last days of being involved in a business. Probably not going to retire. They're going to die in the seat, right? And so there's going to need to be this intergenerational transition of these businesses. You say an air conditioning business. I don't even really know what that means, but that sounds sounds like one of the things that would be involved in this. And like 5 million, that feels like about the right kind of revenue number. And so what's going to happen to all of these businesses? And the idea that someone young and hungry and motivated could take it over and run it. That's a good idea. I
think
like
it's
that
amazing.
idea.
I love such firms.
Because the only other idea is shutting it down.
Yep.
That's plan B.
You kill the goodwill.
Yeah. I think it's very interesting.
Yep. So let's move on to our deep. Obviously, the reason we got Scott in is for our famous deep dive, and we've got our heads together and come up with a fantastic deep dive today, which is Accent Group. I think its code is AX1. It's a great ticker. And if you haven't heard of...
Why is that a good code? Accent. So the A...
Axe.
The A, I know, but
Axe is great.
I know.
Is the one your issue? You've got an issue with the one?
I think it's a great code.
I always feel like ones... When you start putting digits in your code, that feels like the domain of microcaps, doesn't it?
I don't mind it. Anyway,
well, there you go. We can agree to disagree on that.
If you haven't heard of Accent Group, you certainly would have heard of its brands, and that includes Athlete's Foot, Hype DC, Platypus, and for now anyway, Glue Store. They're about to shut them down. They also held exclusive distribution rights for global juggernauts, including Skechers. I didn't actually realise they owned Skechers, which we talked about in the pod. Hoka, of course, Vans, Doc Martens, and Saucony. It's been a volatile stock, to say the very least. It went from 65 cents in 2011, then halved to 32 cents in 2013, then six-bagged to $1.80 in 2016. The roller coaster ride continued, then dropped to 68 cents when COVID happened, and then flew to $2.94 in the COVID boom of 2021. So that's basically a four-bag,
Was that
and a half
the
bag.
COVID boom or post-COVID boom?
During 2021.
Oh,
so
okay, all right.
And it was worth $1.5 billion. This was its peak value, really just the 2021, peak COVID. Peak COVID share mania, not peak COVID virus mania. The share price then slumped back to $1.26 the next year. So it's literally up and down like a yo-yo, this thing. And then in 2024, it rebounded again. And then it's been on a spiral ever since, back down to 55 cents last month. So this is back to sort of 10 years ago stock prices. And then Frasers, which is a big UK business, we'll talk about more in a second, launched a takeover bid. Accent remains obviously very subject to consumer whims, but produced very consistent revenue growth. In 2016, the business generated $440 million in revenue. That grew to $800 million in 2020, so almost doubled in that 4 years, up to $1.46 billion last year. So it's been a pretty consistent grow up. Problem is its earnings hasn't been quite so flash. So whilst revenue was up last half from 775 to 816, net profit has been far more volatile. It rose from 30 million in 2016 to hit 58 million in 2020. So that's pretty good. And the Hoka craze actually boosted profit to basically 90 million in 2023. So that was its zenith. Then dropped to 58 million last year. Even worse, in the most recent half, which was December half, it announced that profit dropped from $47 million to only $28 million for the half. Obviously, December half is a big half. That's a disaster. And that was really driven, and we'll talk more about it, by just a huge increase in COGS. So the business saw gross margin collapse, my calculations, 57% to 47% over the last year on year. Management gave 3 reasons for this drop, and none of these really inspire any great confidence. One was a high discount retail environment. not great. Second was forced inventory clearances, which means they stuffed up their inventory buying. And third was the AUD USD currency hit, which, again, no real excuse. And the currency wasn't even that bad.
And it's
last
unwound
half.
now anyway.
And it's unwound, yeah. So a few weeks ago, the business announced it's closing its glue store operations, shutting 16 stores. I think they paid like 15 or 20 million bucks for that. They've lost another 10 million. That's been a disaster. On the positive side, cash flow remains strong. Operating cash was up 106 million in December. Total cash was 65 million. Obviously, there's some working capital stuff happens in December. The business reported EBIT. This is after lease costs, which obviously are really impactful, of 57 million bucks last half. This was down 30%. Business has 898 stores and opened 27 in the last half. So many
stores. Can I tell you a little game that was played, not by me? They did this research, which is they showed investors old newspapers, and they showed them the front page of the finance section, and they said, you have to buy shares based on knowing, you know that this has happened. You can go back to yesterday and buy shares based on what you see. And everyone does terribly because it turns out it's really hard to guess the way markets move based on headlines. Actually, AI does better than people on it, but it tends to over-bet on stuff and then blows itself up. Claude did the best, actually, of all the AIs. The reason I raise that is if all you got to see in this business over the last 15 years is their revenue and earnings numbers, I think you would never guess that the share price had been this volatile.
Certainly revenue, profit less so, but like revenue's been super steady.
Yeah, and revenue growth, and then it's steadied out a bit.
So what's the name of the CEO and when did he join and why is he special?
Daniel Agostinelli.
That's correct.
And he's obviously under some ASIC
when
investigation
did he join?
now.
When he joined? How long has he been running this show for?
He's Brett Blundy's guy, wasn't he?
10 years?
Yeah, he came from one of Brett's businesses.
Well, I think he was involved in Sanity.
Yeah, I think he's a co-founder of Sanity, I think he was.
So we should point out with this guy, so I like businesses where you can say, this is a good business run by a high-quality person, ideally a founder, but Daniel would tick that box. This is a Brett guy, you know. And
Brett was an owner of this business, of course.
Yeah, and so let's just buy this business, go to sleep for 10 years, and open the drawer again. And the reason I wouldn't have done it with this business, and I think it's easy for me to say in retrospect, but the reason I wouldn't have done it is I think this fundamental business is not a business I'd want to own because it's historically been a third-party retail business with margin challenges that you flagged. But this is I just want to say this is a special guy. I don't know how long he's been running for. I thought you'd know the answer to how long. That's why I asked it. Probably a decade could be.
Yeah,
he's been running this business.
Yeah.
This guy, he's wealthy from his previous stuff.
Yeah.
He lives in a $20 million penthouse.
Yeah.
I only know that because I saw it in the newspaper. This guy
and the management team. I've met quite a few. I met the CFOs.
They're
good operators. It's a good team as well.
Yeah, and the track record on revenue and profit up until just recently is pretty compelling.
That last half was not great, but till then it looked okay.
On the shopfront side, it just so happened last weekend I was out shopping with my family and we were looking for some shoelaces. They're really hard to find, actually.
I'd use Amazon for that one, I reckon.
I needed specific ones and I wanted to see and feel them because
I
ordered off Amazon and I got the wrong ones and I got in trouble. So I had to go in.
This is the low point of conversation. Basically, you want specific shoelaces and you think going to a mall and hunting them down is more effective than the internet.
We had some.
Did you find
it? I ended up in Athlete's Foot.
Oh, okay.
And this is where it's in. Athlete's Foot was packed.
Really?
This is Chatswood.
It's a great business.
Packed.
What's that big? That's their main business, right?
Whenever I've been in a Athlete's Foot in Mossman near me, packed.
Yeah.
And it's interesting because the other shops that we went into, nowhere near as packed.
Interesting.
Everyone's in there getting their feet measured, trying to get the right boots. I think it's a little anecdote, but I feel like that kind of foot traffic thing matters a lot in this retail world.
Foot traffic, very funny. Do you know what percentage of people I read this in their presentation. Do you know what percentage of people that shop in Athlete's Foot use their measurement technology?
No.
83%.
Really?
Yeah, wow.
Pretty remarkable. Or 87, one of those numbers.
Yeah,
I can't remember. But some very high number.
Well, and then what this took me to is they've got this great, it's almost I can relate to this more because I struggle with some of the more fashionable stuff. I really can relate to the functional. There's a functional technology here for measuring your foot and getting the best possible shoe. And it's interesting how compelling for me in this business group, like that part of the business was. And where
it's weird, it's not really a cornered research. Like somebody can presumably copy this This is not ASML.
Sure.
But where I'm going with it is that the other brands that they've written off
The glue
are
store
more
stuff.
where you're riding
brand.
trends, which
Yeah.
is
Still
interesting.
sees
So where you're
t-shirts
getting
and
the
stuff.
variability,
Exactly.
and in shoe wear they seem to do excellent, which I feel like can often be, and it's in the functional space in this athlete's foot. Let's call it functional.
Well, that is
But
what
then
it's called. I think that's a great distinction. Functional versus fashion or
Yeah.
streetwear. That's
Yeah.
what they call it.
Yeah.
That's a good distinction.
And I think that's what I started thinking about in this group is that then they've got the fashion ones are hard to ride because you're either riding a trend and you're doing really well, or you're on the other side of it and you're having to write off your stores and shut them down or write off
Well,
brands.
that glue store is a disaster. If you look at the best advantage they have, and I remember speaking to the guys probably about 3 years ago, and they were going pretty well about this, and Hoka's the great example, was the beauty of owning. So the core third-party retail business is not a particularly exciting business, but the owning the brands in Australia, that's a bit more exciting. And
if you can do a Mecca and get exclusive partnerships with
is exactly
brands
what
in
they do.
Australia,
Yeah.
that is not vertically integrated, but it's better than third-party retail.
And so the beauty of what they can do is, and Mecca does it as well, is they say they're selling lots of Hoka shoes in 2018. They can go to Hoka and say, we're selling lots of shoes. We're really good at this. We got more brands. We got more stores than anyone. Make us exclusive distributors of Hoka, which they did, and they own that brand in Australia. So that they actually have these great insights because they got this great, call it penetration, great scale. So it's scale into cornered resource, which is a really interesting play, and which is what I think a lot of people love about this business. Obviously, it's had a tough run. The share price has been smashed, blah, blah, blah. But there is an inherent good business in there.
They've got a cornered resource for Hoka in Australia.
Yeah.
If you want to stock Hoka.
And Skechers and Doc Martens.
Because Hoka's the brand of the moment.
Yeah.
If you want to stock Hoka, one way or another, you're going to be paying them.
Yeah.
Like you're going to wholesale buy off them, or you're going to be a customer that goes and retail buys off them. Yeah, I agree with that. What's your thoughts on this whole thing, Scott?
Oh, a lot of my interest went to the takeover.
Okay, well, we'll get to
takeover.
that.
But
that's why I started with talking about how good Daniel is, because he does not. They're trying to make him look very bad as part of this takeover.
Well, I think if you look at the cloud, and Daniel, I really like Daniel, but obviously the cloud around him, there's ASIC's investigating him for insider trading. There was some share trades shortly before an announcement. And his excuse, and it's not a bad excuse, is the chairman okayed it. And the chairman then left like 3 days later. Why are these chairmen okaying these share sales is the question. Like, I actually feel a bit sorry for him here. He's been sort of dragged through the mud. The chairman should have said, no, you can't sell, Daniel. Instead, the chairman stupidly goes, oh, of course, do what you want. And now Daniel's being blamed for it. Like, he's not completely without fault, but the fault really should lie on the chairman here.
Well, we don't know. The thing about this is, I tell you why I'm cautious about this. Again, knowing on the inside, like, it's sometimes there's a moment in life where you change from not knowing something to knowing something. There's a clear line. But there's also a moment in life where something looks less likely and then it looks more likely. There's a moment where that changes. And so the reason I don't comment on this, I'm not trying to shield or whatever. I actually don't know Daniel. But I do think we don't know what exactly went on in that, and that is why, by the way, that board minutes are so important.
Yeah.
And people neglect board
Maybe
minutes
ask KPMG
so
for them.
badly. Yeah, KPMG might have them, but but anyway, I take that point on the business itself, though. Like, I looked at this business. I've followed this for a little bit of time. I looked at it, and it's like, of all of the third-party retail businesses, this is definitely one of the better ones. It's not Mecca. But what you saw in Athlete's Foot when you went in there is something that I've consistently seen over an extended period, and that has a lot of similarities with Mecca. Like that experiential engagement, that has a lot of similarities with Mecca. And obviously what they've tried to do is, like, I'm not the only person that's caught onto this vertical retail thing. Like, they went and bought Style Runner, which I think was basically broke, right, when they bought them. And Style Runner sells a lot of their own stuff. And they've managed to grow Style Runner pretty aggressively and pretty well. And so they are trying to push into this vertically integrated, let's hold more margins. But ultimately today, their business is pretty much a mix of selling their own brands that they have exclusive licenses for, and selling brands, just other people's brands like Nike, through their own stores. That's basically what those they got a little wholesale business and a little vertical integrated business, but predominantly they're still a third-party retailer selling some of their exclusive in Australia brands.
It feels like the future bet on revenue growth is really around, like, shoes really seem to be their specialty, and it's around the market for shoes in Australia.
And they say that because this is a very interesting argument, because like running and exercise is becoming increasingly popular.
Yeah.
Shoes wear out faster.
Yeah, it's a great spot
that's
to be
a good
in.
pitch.
Yeah.
And also like GLP-1, skinny drugs.
Yeah, absolutely.
Surely people are going to be doing more exercise once those really flow through. So there are some arguments for tailwinds. What do you think about, the things that have been going badly for this business?
Well, COGS is the big issue.
Yeah,
Like the
so
fact that
their
their gross
cost of
profit's
goods
been smashed
their cost of goods has rocketed.
And they couldn't really explain, like the explanation they gave, those three explanations, high discount retail environment means your brand's weak or you haven't got any pricing power.
Well, maybe I'd put that down to, I'd say high discount environment is, so you saw, Scott, that the store was full, but you also saw all these other stores were not very full. That's called consumer confidence.
Yeah.
That's called we have to run discounts in order to get people to buy. That is what's going on in Australia right now, definitely.
Yeah, like just on that one, the Hype DC, which is also an Accent brand shop downstairs, was nowhere near as full as
their other brand, obviously.
Yeah. But I'm guessing because that one's more fashion, that's where you're going to have to be running more discounting.
I think that they said that business is also doing okay. That's
looks
not
like
that's not their problem business.
Yeah. Well, it's the thing I was thinking about is if you know that you're going to have to ride these trends, because the write-downs relative to their net profit, I think there's like 8 or 9 million of like lost money on brands that didn't pan out, that they had to wind up. And
that's Glue Store as well.
Yeah,
so Glue Store coming, actually. It's not even.
But do you almost have to, if you're riding these trends, if you've almost got to go into them where you're not taking write-offs. Yeah, like you've got to, you ride them. You've clearly got to ride them because of looking at the Hoka results.
Yeah.
But then it's not over-capitalising what you're going to ride into.
That's a great point, because if you're going to say, we'll take on this brand and make some investment to see if we can make it work, okay, Hoka's a no-brainer because, as Adam said, they're selling a ton of the shoes and they say, we'll be the exclusive. We'll roll out our own stores. In Chatston, they've got a Hoka store there. Yeah. It's full all the time, that store.
And that's run by Accent. That's not run by Hoka itself. Because remember, Lego stores.
Yes.
Lego Alchemy ran Lego stores, but then Lego has the other agreement. So if you're selling Lego into Kmart, that's Lego out of Denmark.
That's right.
So I'm not fully sure Hoka is like that, but
I actually don't know. But my assumption would be from looking at the material that Accent runs that Hoka store, because they talked about rolling one out in Sydney.
Yeah,
so I assume it's theirs.
Yeah, yeah. There's definitely a couple of brands, not just Hoka, but there's a couple of brands where they do the.
I presume Skechers. Skechers is a big brand. We talked about Skechers here before, which is great business, and that massive in India, if you remember.
Yes. But your point is a good point, which is there's the write-downs are not exactly the same as... So there are write-downs where businesses buy some acquisition and then it was dumb. And so then they write it down because like there was a dumb acquisition.
Yeah.
But this is actually, they've got kind of an investment thesis about growing the brand. And so there will be some element of write-downs for the ones that just don't work out.
You know it's going to come,
yeah,
so don't,
I think that's
it's
a great
like don't
point.
overdo it. And it seems to impact net profit quite a bit.
Yeah, yeah. That's true. The flip side is, because, the way the world of accounting works, is that you get the write-down, and that feels unfair, but on the flip side, the money they invested in the years they invested didn't hit the expenses of the income statement. It was capitalised onto the balance sheet. Yeah. And so it all evens out in the end. Yeah. But I take like if you're gonna give them a pass on the downside, you got to say when they're investing, that's also not appearing on the income statement,
If you look at the profit, the business still makes decent, even with its profit drop
makes
last
money.
year. Makes almost $60 million a year.
Yeah.
And it made last half 28. So this is not a business that does
But
make
you
money.
didn't explain the COGS, by the way.
Oh, do you want to do the COGS? Because I was going to talk.
You said all right, one problem with the margins is they're discounting. I'm just going to turn everything into simple words.
Yep.
So one is we're discounting.
Yep.
Two is...
Well, the other one's similar. It's forced inventory clearances.
Yeah, we bought too much
stuff.
of the wrong stuff.
That goes to my thing on if you know you're riding a trend, you've really got to watch over. That's going to come, and I think you got to watch it on. It's hard to tell from the aggregate how they're managing that, but that just struck me as like a...
Who are you going to back more than Daniel Agostinelli to know what to buy? Okay, come on.
Yeah.
Like, give me a break. This guy, every business that has inventory goes through a period of having to clear out the wrong. So that's two. If I kept seeing that, I'd say maybe this guy's lost it. But one.
It's not great. And then the third was the AUD
because they buy inventory in USD.
Yeah, but the USD wasn't super strong last half of last year, so I'm not sure how that's even an excuse. I feel like they're kind of just chucking darts at the dartboard.
So maybe we want to say,
and I feel like you want to kind of pull that out. In something like this, you'd be wanting to pull that exchange out a bit more.
Yeah.
Show us the same.
Rather than throwing
a like for like.
Constant currency basis.
So I agree with basically what you're saying is there's been a dramatic drop in gross margin and it's not well explained in the documentation. I would tend to agree with that.
Well, that's the only explanation for the share, because the share price, the market
that's
cap
not the only
dropped. Well, the market cap dropped like 400 million. Yeah. That's a 6 times net profit after tax multiple. That's a low multiple business that has over 10 years shown they can deliver growth. So it's a crazy low multiple.
The growth's come off a little bit though, right? Like the last year or so, it
still grew though.
Compared to those early years where it almost
it was 5%. So not amazing, but not disgusting.
Yeah, it's not going to get unlike some of the other things. Like it doesn't have that AI risk attached.
No,
to it.
That's why I love retail.
And it's got GLP tailwinds as well.
I'm going to be buying shoes again.
It's actually got more tail. As a sector, there's a lot of tailwinds here. And these guys who started being great executors, they've got great brands locked up. It feels like the market was irrationally punishing them for that COGS issue.
So one thing that I think is playing into it around the share price, at least recently, is the level of dividends to the amount of cash coming in. And just recently it looks like they're borrowing to pay a dividend, which starts getting a bit into, I feel
the
like...
balance sheet's not...
but just to borrow, they've increased recently. They had 100 million or so, and they've increased the facility to 300 million or so. That's my
the balance sheet's there's a bit going on in this balance sheet. So there's core networking. So trade receivables plus inventories less payables is 153. So 150 million inventory there, which is a decent chunk of inventory to be honest. Probably more than you'd like.
On an 800 mil revenue business,
and a 60 mil profit business. But so part of the problem is just because the COGS have gone up so much, the margin's been smashed.
So one way to think about inventory that's often used...
It's 1.4 billion revenue, just to...
so I'm giving the half.
For the half.
So one way to think about it is, and because these businesses are a tale of two halves because of Christmas time.
Yeah.
So that's one. But if we just use round numbers and don't adjust the inventory for the timing, 1.4 bill, 120 mil of inventory, it's 1/11th of the year's revenue. So what's that, 9%? Roughly. So like an 11 times stock turn is maybe the way you'd talk about this. That's fine. That's a fine percentage.
Yeah, and given it's not like they're experiencing that rapid growth at the moment. Yeah. So that rolling of stock should be pretty, given the rate that they're on and the which is where I do come to the paying out of the dividend is a little. I just generally my spidey sense goes off a bit when you see a dividend being paid out of cash.
Oh, it's never great.
Like that you borrowed for, because it should be.
That's
shocking. So let's talk about that whole dividend stuff in detail, because I know you're very worked up about the dividend side of things by the sound of things, but which I take that on board.
I think Frasers is worked up about the dividend.
Well, Frasers we'll get to. You're going to talk a lot about Frasers. That may or may not be true, by the way, that they worked up about the dividend. Keep going. What you were saying?
I think if you look at the balance sheet, so the balance sheet's so you got net working capital of 153, then you've got core intangibles and PP&E. Just forget. I'm just going to ignore that. I'm also going to ignore the lease.
All of their product, plant, and equipment will be fit out.
Yeah. So whatever. I'm just ignore that. Intangibles, obviously, that's just brand stuff. Ignore that. Yep. And then a bunch of lease stuff. I'm going to ignore that as well. Guess that AASB 16. Forget
correct.
That.
Ignore all
so
let's
look at the stuff that matters. So there's net working capital of 153, and there's net debt of 114, so a bit less.
Yeah.
Then you got some what they call tax and derivatives. About 50 million bucks positive on the real balance sheet.
So
it's not a terrible
zero. We can just say the balance sheet is irrelevant to working out the valuation of this company. Would you think that's fair or not?
Well, just the other thing to throw in is the dividends, and also they're under a program of two things. One is acquiring the remaining Athlete's Foot franchisees.
Yes, that's true.
So they need
cash for that
to do that. I mean, they could pause it. If you didn't have cash, you'd say, "Hey, we're just
how much cash they got?
They got net debt.
Well, how much cash they got?
I don't have that balance sheet here. There's I think it's I don't know.
I think it's 36.
Yeah.
36 mil.
36 mil at the end.
Right.
Oh, this is 2025, but I dare say it hasn't moved too much.
36 mil. How much does an athlete's foot store cost to buy?
That'd be a you question.
I have no idea how much each store makes.
Well, so how many athletes' foot stores are there? Wouldn't be that much because
I know there are. There's guys got 900 stores.
There's all these different brands.
I know.
So let's say half for athletes' foot, or less than that.
I think your point about acquiring the franchise stores is important, and so let's say this. It seems like it costs somewhere between $600K and $1 million to buy a franchise store.
Per store, yeah.
Per store, and they've got 30 to go, according to their own presentation. So they're not going to buy them all tomorrow afternoon. They'll be able to have, between the cash and the facility, they'll have enough cash to be able to buy back those stores.
Yeah, so the franchise agreements, I think the last one runs out in 2029.
Right.
Yeah.
So I think that's fine. Would you agree that, because, you talked about dividends, you got these dividend issues you're going to talk about, and then you talked about buying franchisees, but not to teach you accounting because I didn't study accounting, but that doesn't appear on the balance sheet. And so can we agree that's more cash flow issues? So can we agree, I know that the dividends come out of cash, but can we agree that in valuing the company, the current balance sheet, we can ignore that for the purposes, or we can just use an earnings multiple, or if we want to use, talking out what the company's worth.
So obviously the intrigue around this company though is what's happening from a takeover M&A front, which adds a bigger, if we're just talking about how this business is going, it'll be a bit more boring, but we've had some pretty high excitement stuff happening. Why don't you talk us through the Frasers?
Why they, before you just say that, you just threw this throwaway line. They make $60 million of net profit or something. Yep. Okay, they might make less now, but I can't remember what they forecast for this year. But why are they trading on 7 times earnings? And the answer is because they provided effectively a pretty dramatic downgrade in the last month and a half that says conditions are really terrible and we think we're going to do badly. I mean, that's basically why they've been penalised now.
It has been sliding a little bit before that, but right now that's the penalty. So to talk through
what's going on.
The bit that at first I was a little not so sure doing a retail one, but they're not usually my place, but if you're like me and you prefer reading through a Form 604 rather than watching Harry Potter or something, you'll love This is Form 604 is a substantial shareholder notice. If you prefer that, you're going to love this story of there's an epic hostile takeover going on here.
Barbarians of the Gate style.
By Frasers Group. And so Frasers...
In fact, that's Mike Ashley, right?
There's a billionaire behind it. You got a couple of billionaires to throw in to make the story extra fun. But the Frasers Group is no stranger to doing acquisitions. So just for context, Accent Group, there's a takeover bid, and it's a hostile takeover bid from Frasers Group.
Who's already a shareholder.
Who is already a shareholder.
And they're Sports Direct, right?
They're what?
Yeah, Sports Direct. And JD Sports are their big competitor. So Sports Direct, and they've got the license in Australia,
They own Lacoste and a couple of other brands. Slazenger they own.
Yeah.
There's quite a few brands that people would be familiar with that they own. And it's really interesting. So they put a hostile bid over for, I think it's 65 cents.
So basically a zero premium. Which is unheard of, essentially.
Yep.
And the business has been smashed share price-wise. So it's been absolutely destroyed. And they've gone, I'll give you the lowest price you've ever got.
Well, it's had a good month. I'll give you that as a tip.
Yeah.
And so it puts what I want to do is just kind of wind back a bit into where this all started from. So Frasers Group has been trying to get into the Australian market for over a decade. Okay. So this play at Accent Group, it's not just an overnight thing.
With their Sports Direct business,
we can go, so we can go kind of right back to 2014, and Frasers Group acquires a stake in, at the time, what was called MySale.
Oh, back in 2014. They were essentially a competitor of ours when we had a brands exclusive business back in the mid 2010s.
Should have sold your business.
There you go. You could have been acquired
by Frasers.
They
weren't interested at the time. Yeah.
To MySale or Frasers?
No, to MySale. Yeah. We literally did. Yeah, so it was our product business, not our travel business, obviously.
Yeah.
So they bought in while it was public for a small percentage.
And this is a business that was worth like $500 million or $700 million. It was just outrageous how valuable. This was like the adore beauty of the 2010s idea. If you remember the old sale or MySale business, that I remember back in 2013. I remember our good friend Paul Greenberg ran this retail event in Versace in the Gold Coast. And I was like, we were early days with Lux then, so I was kind of like largely the irrelevance there. But there was Gabby from Catch of the Day was a big time, and Carl. And so Jamie was there, who was a really charismatic, great looking guy who was running awesome. These guys, they were worth 400 plus. They hadn't listed yet. They were worth 400 plus million. I think maybe this deal had happened or was about to happen. And
you were fanboying by the sounds of it.
I was fanboying. I remember, but a highlight of that conference is we were in this like session. It was Versace then. It was like very fancy. Couldn't believe I was staying there, and we didn't work with them at that point. And like everybody's in this session, and it's like really serious retail corporate stuff. And the guy who was running Super Cheap Auto was there. So there's like I think Peter Birtle's his name was. There's some big people there, and everybody's like concentrating. And we turn out. Like outside, they open the curtains, and Gabby's like doing laps in the pool. It was like you're not giving less of a shit about this conference, which I think Gabby had it right, to be honest. But Paul did an amazing job.
To hear that.
Paul did an amazing job of getting just every single person in retail was there, other than the Myron DJs. But
that's the Paul's superpower.
He's incredible.
Everybody is always happy to talk to Paul,
and
genuinely happy. To talk to Paul. And
he did a great job. And Jamie was there, and it was peak of his powers. There.
Well, so that's a great so you get a bit of a colour of what's going on up there with Catch Group and everything, and then I think they were viewing it as a way to get into the Australian market. So they in what we'll see is like similar to what they're doing with Accent Group. They started upping their stake, and then they got over 20%, and then they launched a takeover bid.
This is after it became public.
This is after, and then at the same time, which is fascinating, they bought another brand called Sneaker Boy. Out of administration, which people might know. So at the same time they
didn't go back into administration.
They bought the they bought it, and then they put Sneaker Boy into administration. But then looking at what they've done, they've rolled it into the MySale. My guess is a whole bunch of the assets.
Sneaker Boy in Chadstone, I think, got shut. So I presume that was the case. For
they bought it. Frasers was the group that bought it.
Yeah,
they bought it for probably cents on
the dollar.
Out of administration. So and then we come forward from 2022. Get to July 2024. This is just before Frasers first gets involved with Accent. And
Frasers is what, like a $10 billion group or something like that?
Yeah, it's quite a large, it's large international. And this is he's got a bit of a nose for acquisitions. Yeah. You can see.
Amazing acquirer.
Yep. Yeah. And so just before Frasers gets involved, we've got the founders of Accent Group, Craig Thompson, Brett Blundy, few others, but between Craig and Brett, they own 22%. Accent's trading at those all-time highs, up around and above $2 a share, and Blundy probably senses the moment.
He's good, isn't he, Brett? Doesn't get much wrong.
Sells 165 million of his shares.
You could have rung the bell when Brett's selling, I reckon.
His entire block goes to Frasers Group. Frasers Group.
I remember seeing when Brett sold, I thought, this can't be good, and I wonder why he's selling. That was the two things that crossed my mind.
And the announcement at the time is interesting because there's an announcement from the company that says there's a strategic shareholding with talks going on for some time. So they've bought Brett's shares, and then Craig Thompson sells a few months later for a good pop on his shares.
Yeah.
So Brett helped him out there with a bit of it.
Presumably Brett would have said to Daniel at the time, like, I'm going to sell out to Frasers. You're doing a Sports Direct deal. It's going to be good to have them on the register. They're going to be putting one of their directors on the on their board. That's a whole other conversation I'm sure you're going to get to. And I think at the time, Daniel would have been positive about that.
It looks like it, yeah.
Although he sold down a few $1 million of shares at the same time, but not many, 3 or 4 million.
This was the inside trading incident, was it?
Was it?
I must have. That was one of the incidences that he's being investigated for.
Whatever the case is, he sold down a few mil, but I thought he wasn't selling out.
Alleged insider trading, obviously not. We're not saying it was.
And I think that at that moment in time, people maybe didn't see Mike Ashley for the wolf that he actually is, because he was so beautifully dressed and purring like a pussycat. But so I don't think people realised that where this was going to go when that transaction.
And you could look at his CV, it would have been pretty clear that this guy doesn't buy passive stakes in businesses.
I maybe would call a few other people. I mean, like, these are smart people. They probably did this, but I would call a few other people that he'd acquired and said, before he acquired you, like a year earlier, was there a gnashing of the teeth, or was there just a nice purring sound of how we'd work together, you know? I think that would be a good question to ask.
Yeah, and then, so like you point out, Adir, then they put on Frasers put someone on the board. I think it's worth, so they've bought Blundy's share, which is 14.5%. Thereabouts 14.6 at the time, goes down to 14.5. They put a board member on. It's worth just for our listeners kind of explaining the corporate chess takeover chess that's going on here.
Well, the thing is, they appointed a director who didn't work for Frasers. So that looks great. Like, yeah, it's an independent director. We're going to put him on the board. By the way, he worked for me for 35 years beforehand and recently retired and ran the Sports Direct business in some big jurisdiction that they had run. So this is a guy. And so you're sitting there and you're Mike Ashley and you're saying, God, I want to get into Australia. And I think Accent's my opportunity. Yeah. And I just locked up 15% of the company. And but I need to know what's going on. How the hell am I going to know what's going on? Well, one way I can know what's going on is I can do a Sports Direct deal. That's going to be good. That's going to get me some information on how the business is going. That's some information, but I want more information. So how about I appoint someone on the board that ran a chunk of my Sports Direct business and that I really trust? I think that will really nail the information flow for me. Now, I don't know that he did that. The director shouldn't really be doing that, but my guess is there was some high quality info that was flowing back to Frasers Group from this director.
Well, they went in before the partnerships announced, so the shareholders are bought, the board members on, and then a year later they announced the strategic partnership, and it's kind of curious from the outside as to what came first, the chicken or the egg, the strategic partnership or the shareholding.
Doubt, I think the likelihood that Frasers did not have in mind using Accent as their distribution partner for Sports Direct in Australia at the time they made the acquisition. The likelihood of them not having that thought is 0%. Like, that's got to have been
It's also, plan. When you think, if you're Mike Ashley and you want to get this business as cheaply as possible, they do this JV. They've got to roll out these Sports Direct stores. That's got pretty significant CapEx. They're distracted. That's a lot of work. Yeah. Great. They're going to be, while they invest in these businesses, they're going to be a bit weaker. So Mike says, you just go spend a couple $100 million on this, and then go, boom, I'm going to take you out when you're a bit weaker.
The flip side to that argument is the way to not get this business cheaply is to buy 15% from Brett Blundy at the top of the market, right? Yeah. So that's the corollary of that
that's true. That was, in hindsight,
or the opposite.
Brett clearly sold at the absolute perfect time. You couldn't have got a better sale than that.
And I don't think, my honest view is, I think when Brett sold and Frasers bought, Frasers was not of the view they were overpaying for that stake.
I don't think Mike wants to overpay for anything.
I think everyone thought this business was going to be doing well, and like whatever his long-term plan is always take it over for as little as possible. But I don't think
you're kind of going to win. You're going to win either way. Either they're going to bring Sports Direct in and it's going to go really well and you get the bump on the share price, or if it doesn't, goes a bit in the middle, you can buy it for a bit of a cheaper.
Well, even when they bought it, they're making not $90 million NPAT, 1.5. It was like 17 times NPAT multiple. It wasn't a crazy valuation even back then. It's just gotten a lot cheaper.
And they, Accent Group, to drive their growth, needed this Sports Direct deal.
Yeah, they needed.
I think, again, if all I showed you was this deal, and I said, how do you think this turned out? At that moment in time, project 4 years forward, I think we'd be pretty likely to say this seems like a sensible arrangement.
Well, can I just
it probably went well.
One little asterisk. If you go to the Australian market, caught for category killing sports stores, Rebel was the original one, but I'm not sure there's that much space.
So, I think like Foot Locker, you would say, is a competitor to Athletes.
Which is owned by Dick's Sporting Goods, the massive US giant.
Massive. One of the world's most popular sports apps. Do you know that Dick's Sporting Goods
sells more guns than anyone else in the world as well?
Guns, has one of the world's most popular sporting apps.
Yeah.
Like, actually, it's crazy.
Going really well. Yeah,
but
great business.
I think Foot Locker is kind of a competitor to both sides of Accent's business, the performance side of it and also the leisure side of it.
Yeah.
I guess that's a big question, Adam. It's like that's the big market question. Can it fit a Sports Direct, Athlete's Foot
Locker, Rebel?
Yeah. And we're not the UK. We're not London, where you can go down Oxford Street and there's all these different stores and they're all full.
There's only 26 million people in this country.
Yeah.
Maybe we're all buying out more shoes than we realise for running. Maybe they accept
well, we probably are, but also you have to remember there's Nike's own
stores,
absolutely, as well. Well, one of them, one of the big franchisees of that went broke in New South Wales recently. So this is, I think, I was going to say this at the time, but I just want to let the conversation keep going. But you talked about 5% growth.
Yeah.
Now, there's two ways to look at that. The way Athlete's Foot positions that is, it's growing faster than the industry. Footwear is on a downward trend. If you look at the US footwear index, like for public companies, it's gone down.
Which is Nike,
dramatically.
Adidas, Puma.
That's predominantly. And so we always grow faster than the system growth. That's what Foot Locker, that's what Accent says. That's a good argument, but the flip side of that argument is, God, it's terrible how slow the footwear industry is actually growing. Like, it's growing really slowly.
Doing barefoot running, I reckon.
And so there's all these, you've not
dragging
contributed.
Destroyed the industry.
So whilst, like they do grow faster than the system, and there are all these tailwinds that we think maybe are coming through the industry, in the short term, there's a headwind. There's a few real headwinds in this industry, and their company update that they gave when they buried the ASIC announcement in there was basically, we think the war in the Middle East is going to further increase our COGS problems. So, like, there are short-term headwinds in this.
But it does feel
business.
Like this is a very undervalued business.
Well, I'll tell you the real. I think we got the numbers a bit wrong. So they say they're going to do 80 mil of EBIT ballpark. I'm taking could do more. And when I look at their EBIT, the thing about their EBIT is they got interest expenses.
Yeah.
And so I think that after interest, that 80 could be 55.
Yeah.
And then they pay some tax. Maybe they get to 35, and they're valued at 400 mil. I think this is more like 11 times earnings.
Yeah, but you're talking EBIT's only like what?
EBIT 80.
So 5 times EBIT feels very cheap.
It depends how much you want to consider.
I've got
you
it
can't
6.6 times based on last 12-month EBIT roughly. So,
but I think they gave you an EBIT for FY26.
Yeah, used LTM,
which was 80. They said we think we're going to do 79 to 84. And so the question is, what do you think about? Because there was all sorts of allegations thrown at Daniel, like, he got an 82% vote against his REM. Did you see that? For increasing his pay $300K.
Yeah.
On that size business,
whilst reducing dividends. I mean, what do you think they're going to do with dividends in this business?
Depends if Frasers buys it or not.
Let's say that.
I feel like they got to stop the dividends.
Freeze
or reduce them. I think maybe not stop them, but reduce them.
I don't know if they've got the option. Like, if you're committed to the plan of buying these, even though it's small, they're not really in a cash accretive situation.
So you think they might freeze dividends? Yeah, it's possible.
And you assume that I mean, I'm not a shareholder, but if I was, I'd be thinking, I want this Sports Direct deal to succeed. They're investing in that still, by the way. They're investing in that. They're investing in buying back
slowly.
I want you want the group. They're in a good spot as a business market wise, like we're talking about. I want that to succeed. I feel like the dividends are going to hurt my capital growth.
But what's Mike Ashley saying? He's saying, you losers, you're running this business backwards. The share price is tanked. You're paying out all dividends based on these crazy dividend numbers. You increase your salary, 82% of people voted against you. ASIC's investigating you.
There's been some own goals
You're
here.
slowing down the Sports Direct rollout that you promised me. Like, get rid of
all
these
that stuff
guys.
Is actually not. He's probably right.
It's a good narrative,
it doesn't mean that he's getting a steal here. If he pays anything less than, I reckon, 800 million, it feels like it's being stolen.
So the share price already above what he's offered.
Yeah, but still only 20%.
So what do you think about? I'm going to call it 5 times EBIT, because a lot of the EBIT gets eaten by this interest expense.
But interest, that's agnostic.
Well, that's why I said 5 times EBIT.
Yeah, it feels so cheap.
It feels cheap. I agree. This feels cheap.
Yeah, 100%.
I think they'll buy this business. If he wants to buy this business, it'll cost him $1. What do you say to that?
$1. Oh,
90 cents to $1.
And what's that in market cap terms? 800 million or so?
It's like, let's call it 50% more than the current market cap.
Like
so
600
6 to
that
700.
Still feels
Is
cheap
that right?
to me.
Honestly, say if he's paying $1 instead of 65 cents, the total would be 700, about 700 million.
Cheap to me. It feels like it should be $1 billion.
15 times net profit would be around there.
But if you go and it feels cheap, but if you go and offer an investor who 5 seconds ago was sitting at 55 cents.
Yeah, for sure.
If you go and offer them $1, and by the way, we're cutting your dividends are going to be cut, so you can forget about those anyway. I think they would get this away at $1. I'm not sure Mike actually wants to pay $1 for this company.
We obviously want to pay as little as he can, clearly.
But I think $1 would get this across the line.
I agree with you. That's why I think we'll absolutely get it done. But I think it's probably still a really good buy for Mike, who's obviously a super smart guy, and he's been doing this for 20 years. He started the business from nothing. This is a guy who understands M&A almost better than anyone.
Well, I don't think he's going away either because
Yeah.
they've been working on the Australian market for 10 years.
And he owns a big chunk of this
10
business. So
years
it's kind
now.
of, which is another, anybody who's a shareholder knows, well, this guy's got a blocking stake because no one else can acquire it. So this is really the only show in town. Hedge funds start coming in, give it the old bear hug. He's going to get it. The question is at what price?
And you're right with your comment about he can't lose. Like either this goes badly and he gets it more cheaply, or the sports director role that goes well, and this company becomes increasingly more dependent on him as part of their growth strategy.
Yeah.
Like, I mean, this guy has maneuvered himself into a great
You
situation.
don't make $6 billion US unless you're a pretty good operator, and Mike clearly is. On that note, we're going to have to wrap it up. Great to see you in the studio as always, Scott. Thank you, Adir.
Thank you for having
We'll
me.
see everybody back on our big episode on Tuesday.